everyone, and thank you for watching my videos. So far, we've learned about fundamental analysis and how important it is. Now I want to continue to study more about fundamental analysis by talking about currency crosspairs. A currency crosspair is any pair of currencies that do not involve the US dollar as either a base currency or a cross currency. So, what I want to do now is I want to give you an example as to how to create a cross currency. So, let's say we have two pairs. We have the British pound US dollar pair and we have the US dollar Japanese yen pair. And we have the bid and asks of the respective pairs. So, let's create a British pound Japanese yen pair. So, in order to do that, we must multiply the two bid prices, which would be 1.563 and 89.38. So, let's multiply the two. The answer is 139.7. That would be the bid price on the British pound Japanese yen pair. How do we get the asking price? By doing the same thing, multiplying the two asking prices, and we get 139.82. Now, why is this important? Well, it's important because 90% of all the transactions in the Forex market, they all involve the US dollar. So, the US dollar creates a lot of volatility in this market. So, we're going to work a lot with the American dollar, so we need to know much about it as we possibly can. And we also need to know that many countries around the world, such as China, Japan, and Australia, they don't have their own supply of oil, so they have to import oil from other countries. And most oil companies and most oil reserves that are owned by governments and groups, they quote the value of their oil in US dollars, which means if China, Japan, and Australia want to have more imported oil, they need to pay for it in US dollars, which means they need to have large amounts of US currency in their reserves, which means the demand for the US dollar is high right now and will continue to be high. So, let's talk more about the US dollar. Here in this chart, we have the pit movements of the 7 most popular currencies, or otherwise known as the majors. So, in 2009, there was a lot of negative movement among the majors. However, in this video, positive movements and negative movements are not relevant. What's relevant is the amount of volatility. Notice that the top 7 currencies in the world, they all involve the US dollar. So, the US dollar creates a lot of volatility in this market. So, that means when we enter the market by going long or going short, we're either taking a pro-US stance or an anti-US stance, because all the currencies are somehow affected by the US dollar. Even if that pair does not involve the US dollar, it is affected by the US dollar either directly or indirectly. And also, conversely, in the stock market, traders have multiple companies to choose from and are not bound to one major speculation idea. It just means the companies that are in the Dow Jones market, any news that affects one of the companies is not going to affect the rest of the 29 companies. There's 30 companies in the Dow Jones market, in case you were wondering. So, any news story that involves one of the companies is going to affect just that company as well. So, let's talk more about the Dow Jones, because by learning more about the Dow Jones Index, we have a better understanding as to why the Forex market is so sensitive when it comes to news about the US dollar. So, here's what we need to know about Dow Jones. There isn't just one kind of speculation that affects an entire basket of stocks. Again, it takes more than just one news story to affect that entire index. Now, instead of looking at the 7 major dollar-based currency pairs, currency crosses provide more currency pairs for you to find more opportunities. So what this means here is before we looked at the British pound US dollar pair, and then we looked at the US dollar Japanese yen pair. Those are 2 pairs. By creating a 3rd pair, that means we have more opportunities to get involved in the market. So again, we spent a lot of time talking about trends. We spent a lot of time talking about playing the bounce or playing the break whenever the candlestick breaches the line of support or breaches the line of resistance. Sometimes we miss out on those trends, so it helps us to have an extra pair to look at. That's what we get in the Forex market. We don't get that in the stock market, because in the stock market, you're either taking one position at a time, either buying or selling. But remember, in the Forex market, we're dealing with pairs. We're buying and selling at the same time. Okay, so to give you an idea as to how important the US dollar is, I've listed all the companies that are in the Dow Jones. As you can see, these are world famous companies based out of the United States. Therefore, this lets you know that the demand for the US dollar will continue to be high in the years to come. Now, this is really not important to know, but for those that are seeking a deeper understanding as to how the Dow Jones market works, I placed this formula, which is what they use in order to calculate the daily volume of the Dow Jones market. So, again, I do want to stress following up on the volume, because any significant changes in the volume in the Dow can affect how the US dollar performs in each session in the Forex market. So watching the volume of the Dow is important. Okay, so, and again here we have a chart that shows us the movement of the volumes on the Dow Jones Industrial Average. So again, this really, how does this pertain to the Forex market? Well, it doesn't really pertain that much, but it's showing you just how important the US dollar is in the Forex market. When you have so much movement in the Dow Jones market and we have so much volatility in the market, it means that the US dollar gets moved around from place to place so many times that it creates a lot of noise in the Forex market. Okay, so to give you an idea as to what type of impact the US dollar makes in a currency pair, this chart right here shows the movement of the euro-dollar pair. Notice that we have a downtrend, then we have an uptrend, and then we have a lot of movement here on the, after the uptrend, it's moving sideways and then it's going back down. And notice that the candles in between, there's a lot of volatility, as we can see with the shadows. So remember, when we read candlesticks, shadows indicate volatility. So this is the euro-dollar pair. This right here is the euro-yen pair. Notice how the market is smoother. Notice how even in an uptrend, the candles are nice and snug between the lines of support and resistance. Now remember, this can be because that anything involving the US dollar creates a lot of volatility. There's not too much volatility involving the euro-yen pair. Okay, so now let's talk about interest rate differential. We had an introduction to this in the previous video, so I want to show you more about why this is important. So, currency crosses, they offer many pairs with high interest rate differentials that are primed to these types of trades. So again, we want to study the interest rate differentials in the cross pairs because, again, this can affect the direction in which currency values go in this market and give us an idea as to what type of strategy we can plan. Okay, So in this market, we have the Australian dollar Japanese yen pair. And here we have an uptrend. So what we're looking at in this market is the fact that the Australian central bank, they have they historically keep their interest rates high, whereas the Japanese yen pair, or the Japanese central bank, the Bank of Japan, which is what the Japanese government calls their central bank, generally keeps their interest rates low. And by looking at this chart, notice how we have smooth uptrends. Notice how the market moves smoother, not so much volatility as anything that involves the US currency. And that's because of the history of keeping Australian interest rates high and Japanese interest rates low. So, let's talk about obscure crosses. Here's an example of an obscure cross. Here we have the Australian dollar and Swiss franc pair. Notice that we have a lot of spikes in this pair. Notice how the candlesticks are always long. We have a big bearish, big bullish, big bearish, big bullish candle with lots of shadows above and below. Many investors, when they see a chart like this, they'll just stay away from it completely because it's very unstable and there's really no way of determining which direction to go in this market. So it is recommended for new investors to stay away from obscure crosses. Look for smoother charts to go with. And here's also another example. Here we have the British pound Swiss franc pair. When we see a really choppy zone just like this, it's really not a good idea to get involved in the pair. So again, if we're not able to determine who is in charge of the market, the bears or the bulls, if we're not able to see a clear trend or any patterns, it's best to just stay out of the zone. Okay, now let's talk about planning around news and fundamentals. If strong economic data comes out of Australia, you want to take a look at buying the Australian dollar. And the first reaction might be to buy the Australian US dollar pair. So if we want to invest in the Australian dollar, we should first look at the Australian US dollar pair because anything involving the US dollar is going to have the most amount of volatility, meaning you will receive your biggest profits from that pair. So again, anything that affects the Australian economy, we want to focus on the Aussie US dollar pair. So, and at the same time, recent data also show the US experiencing strong economic growth. Well, price action of the Aussie US dollar may be flat. So again, before we get involved in any currency pair, check the news. Check to see what the chairman of the central banks are saying. Check to see what the governments are reporting. And also check to see how consumers in the respective countries feel about the economy, the central bank, and the governments, because all of those factor in as well. Okay, so here's what else that we need to keep in mind. We can even make synthetic pairs, okay? Now, again, synthetic pairs, this gives us more opportunities to make more investments, and just in case we were focusing on one currency pair and we missed the boat on an uptrend or a big downtrend, well, we can shift to another currency pair to see what's going on there, and maybe we can catch a trend before it happens on that pair. So remember, we can make more pairs in order to make more opportunities and to give us more advantages every time we enter the market. Okay, so some information about synthetic pairs before I show you what they're all about. Institutional traders can't trade certain currency crosses because they trade in such high volume and there's not enough liquidity to execute the market. Meaning the spread might be too high. And high spread means the profits are lower. High spread also puts your account in danger because if the market goes the opposite way, then you lose more capital. So sometimes when we see a currency, when we see a pair and we want to get involved, but with that high spread, it makes that pair seem to be rather unattractive. So that's another reason to create synthetic pairs as well. So without further ado, let's learn how to create a synthetic pair. First, we have a British pound Japanese yen pair. Let's say we want to get involved in this pair, but as we can tell, the British pound Japanese yen pair, for some reason, it's not a popular pair, meaning the spread is too wide, meaning when we jump into the pair, we're automatically deep in the negative. So let's see if we can get involved in the pair in some different way. This is how we do that. So let's say we want to buy the British pound and sell the Japanese yen, otherwise going long on this pair. Well, we use the US dollar. Again, we're learning how the US dollar is important in this market. Watch what we do. So we go to the British pound US dollar pair. We buy the British pound and we sell the US dollar. Then we go to a third pair, which is the US dollar Japanese yen pair. And here we're going to buy the US dollar and sell the Japanese yen. Now, the US dollar represents the legs in our synthetic pair. So from there, because we have our legs, the selling of the US dollar and the buying of the US dollar cancels each other out. So what we're left with is we're buying the British pound and we're selling the Japanese yen at a spread that is lower than if we bought it directly, than if we went long directly from the British pound Japanese yen pair. So we can save money on the spreads by creating these synthetic pairs, as we can see. So let's talk about euro crosses. The most popular euro crosses are the euro yen, the euro pound, and the euro Swiss franc. Now, news about the euro or Swiss franc affects the euro crosses more than the euro dollar or American dollar Swiss franc pair. So the euro, as we know, is very sensitive to anything that comes out of the news. Anything about civil unrest, political unrest, or what's happening in one of the members of the Eurozone. So when we work with the euro, pay close attention to a lot of the news stories that come out of the European Union, because the euro is a very sensitive currency, just like the US. Okay, and now let's talk about yen crosses. The Japanese yen is one of the most popular cross currencies and is basically traded against all the other major currencies. Well, that makes sense because the value of one Japanese yen is significantly lower than the value of $1, €1, €1 franc, £1. Well, you get the idea. So, also another reason why the Japanese yen is so attractive is because the Bank of Japan historically keeps their interest rates low. So again, perpetuating the fact that the Japanese yen is considered a safe haven currency. So let's say we want to trade the Japanese yen cross pairs. Here's what we need to do. First, we need to keep an eye on the US dollar Japanese yen pair. And when key levels are broken or resisted on this pair, it tends to spill over into the Japanese yen cross pairs. So again, we're paying attention to not only what happens in the news about the Japanese economy, but we're also paying attention to what happens in the news about the American economy. That also affects the Japanese yen as well. Okay, now let's talk about the Canadian dollar Japanese yen pair. There has been a lot of volatility in this pair over the years because Canada has increased their natural oil reserves so much over the years, and with the Japanese yen dependent on foreign oil in order to produce the technology that they've been producing, that creates a lot of volatility. So many investors in the Forex market are very attracted to the Canadian dollar Japanese yen pair. So here's what we need to know about the Canadian dollar Japanese yen pair. We also need to know that Canada is the second largest supply of oil and is benefiting from the rise of oil prices. So the price of oil rises, the Canadian economy gets stronger, and the Canadian dollar gets stronger as well. Japan is very dependent on oil. That country imports 99% of the oil that they need to run their hard economy. And the prices of oil has an 80% positive correlation with the Canadian dollar Japanese yen pair. Meaning, what happens to the price of oil greatly affects the Canadian dollar Japanese yen pair. So, pay attention to what happens to the price of oil. That has a profound impact in the Forex market. Now, how do we trade the crosses? We do it like this. Let's say you want to see a buy signal for the euro dollar pair and the pound dollar pair, but you can only take one trade. So, which trade do you take? Well, in order to find out which pair to take, we look at the euro pound cross. And if the euro pound cross is going down, that indicates that the pound is getting stronger than the euro at the moment, which means many investors will go long on the pound dollar pair in order to save money on the spreads and to maximize their profits. Now, let's say we can't decide on whether or not to go long on the euro dollar or to sell the dollar franc pair. Well, let's look at the euro franc pair. And if we can't decide on whether or not we should go long on the dollar franc pair or the dollar yen pair, well, look at the franc and yen pair. So what we're doing here is we're looking at two currencies, and if we're not able to decide whether or not we should go long on this currency or go long on that currency, make a cross pair. And then what happens on the cross pair can determine which currency we should get involved in. So as we can see, getting involved in currency cross pairs can give us an idea as to which direction we should take, which strategy we should create, and again, increase our chances of making the right strategy and therefore maximizing our profit and having a strong advantage in this market. So here's what we've learned. We learned that trading obscure crosses can hurt us because it's very difficult to monitor the market, and it's very difficult to use technical analysis when we're dealing with obscure crosses. Too many spikes. So it's best to not get involved with the obscure crosses. And again, we've also learned how to make synthetic pairs in order to save money on wider spreads to make the spreads narrower. And we also learned that studying the US dollar can help us understand what's happening in the Forex market. And we also learned that the price of oil affects the market as well. So again, fundamental analysis can affect the market much greater than technical analysis, because fundamental analysis is what drives the market. Technical analysis can help us read and understand the direction that the market's going in. So use both, but also appreciate what fundamental analysis can do when we make our trades, because the certain types of certain types of news reports and certain types of economic data that's released can tell us which direction the market's going in. And if we can pick up on that early and react to it early, we can have a really good advantage when we're investing in this market. Thank you for watching this video, and good trading.